Now, analysts say the CBN's hawkish stance has burst a bubble for Nigerian equities, with more investors taking advantage of the higher yield environment at the fixed income market. Now, as the market focuses on the next move of the MPC, traders say bargain hunting was observed this week on Transcorp, Zenith Bank and Boa Cement. Mercy Okon, research analyst at Parthian Securities, joins me now for more market movements and the build up to the March MPC meeting. Mercy, thank you for joining us today.
Thank you for having me.
Let's start with overall market performance so far this week. I believe the market, we saw the first positive trading on Thursday when the market tried to claw back some of those losses. But how would you describe overall sentiment, especially since that last MPC meeting and, of course, ahead of the next MPC meeting?
So it's been sort of mixed to bearish, and that's because it seems as though investors are taking a more cautious stance. And that's because of, the market has been waiting for some form of positive triggers to spur up activities in the market. And it's safe to say that one of those triggers that the market is expecting right now is the outcome of what the full year earnings result will be for the banks. So yes, this week has been slightly mixed to bearish, and this is because we had 3 out of the 5 trading sessions closing negative. However, as of Thursday, we saw a reversal of the first 3 losses in the first 3 trading session of the week, and this was largely because of the gains seen in Boa Cement and also because of 4 out of the fugas, closing positive.
Now, at the beginning of this year, the market was on full steam, becoming one of the best performing stock markets even in the world. But then we had that MPC meeting, and what we've been seeing since then is just a few steps forward, a few steps backwards. One day the market is in profit-taking territory, the next day it's in positive, just moving about. But what we've also been hearing is that there may have been a significant exodus of investors to the fixed income market to take advantage of higher yields. Can you confirm that to us? Is that something, was it material? Did it materially affect the market?
So yes, ideally, whenever there is an hike in interest rates, it's negative for the equities market, and this is because there seems to be a positive correlation between the hike in interest rate and the fixed income market. So whenever there is an increase in interest rates, it is positive for the fixed income market, and then you have your investors who have low risk appetite exiting the equities market to put in their funds into the fixed income market, because they want to put in their funds into safer haven, and that guarantees a safe return. And it's safe to see that one of the cautious stance that we started to see, which was a trigger of which led to the quietness, or should I say the slowdown in some of the activities we saw in the markets from what he did at the beginning of the year, right? At the beginning of the year, which was January, right, was because of market reaction. So you have investors not certain of what the outcome of this next meeting would be, for instance. So, we have the MPC meeting coming on Monday and Tuesday, which is why I also personally expect that the markets will be negative for the first trading day of the week, and this is because of the uncertainty surrounded by what the outcome of that meeting will be. So I do not expect that we'll see an hike. We would see them raising interest rates for this next meeting, because we haven't seen the impact of this last hike on the inflation report yet, and this is because inflation is a lagging indicator, right? And we won't see the impact of this last rate until we start to see the inflation reports for April and May. So yes, hiking interest rates is negative for the equities market. But like I said earlier, it seems as though the market is waiting for some form of positive trigger. And that positive trigger right now, it's safe to say the expectation of what the outcome of the banking stocks would be is part of that. And that's why you see that as of today, the market did close positive by 0.29%, which was largely driven by the banking stocks. So you can already start to see some form of renewed investor sentiment, in the sense that you have investors who are now trying to take advantage by positioning ahead for what the outcome of the result will be, because we're expecting that the result will start rolling in anytime from the last week in March into the first week in April.
Right. Now, following that rally that we saw in the first 2 months of the year, where has that left the average stock in terms of valuations? From the banking down to in the industrials. I know that industrials, the likes of Boa Cement, Dangote Cement, for instance, have been investor favorites outside of the banking sector. But in comparing these valuations, especially to other frontier or emerging market pairs, where do those stocks stand?
So I didn't get the question. Are you asking what the sentiment is for the banking stocks? Could you take that again?
So valuation of Nigerian stocks, how do they compare, in summary, compared to the emerging market pairs? We saw that rally in the first 2 months of the year. Many of the stocks did rally. I mean, I was looking at a stock like Julie, for instance, a penny stock, but Julie Pharmacy, that stock has rallied significantly in the last, since the beginning of the year. So that's what I'm getting at, looking at their valuations right now. Where do they stand, and what can you tell us?
So I would say that there seems to be some form of positive tilt towards the banking stocks. And I mean, that's not far-fetched, because if you look at the full year result of some of these industrial goods stocks, you would see that the losses in terms of you would see that the losses in terms of FX evaluation loss, and also because of the hike in the finance costs, you saw how that impacted on their bottom line. However, the expectation is that the result for Q3 for the banking stocks would be high, because if you look at the Q3 results of these banks, you would see that it was quite impressive, and some of them had already done past their full year 2020 result, and this was as a result of the FX evaluation gains. So yeah, we're expecting that this would trickle down into the full year 2023 result. And we know, and then again, there's the fact that the banking stocks are a good buy because of the whole cost structure. So yes,
Right. So what are the stocks? So what stocks do you like right now? What are the stocks on your radar? And also, what are you seeing investors buying? I knew there was yesterday, Transcorp, Zenith, and Boa Cement, three market heavyweights were investors' favorites. But what stocks? What is the trend you're seeing?
For the stocks to watch out right now, I think the banking stocks are a key watch right now. And this is because, yes, one, there is strong expectation for the result. There's also the expectation that dividend declaration will be high. And also, if you're looking at the price to book valuation of the stocks, you would see that most of them are underpriced, and they're at an attractive price currently compared to what they were trading on at the beginning of the year. And there's also some form of positive sentiment or positive signal in terms of the technical analysis as well. So yeah, I'll take the banking stocks.
Now, I'm thinking about where inflation is right now at over 30%. And I'm thinking about the consumer goods companies. I'm thinking about consumer spending and the impact on consumer wallets. How do you see these companies in the consumer goods space maneuvering the environment going forward while we wait, hopefully, for inflation levels to begin to trend lower? I know that many of them are obviously dealing with higher energy costs, higher operational costs. There's a tendency to pass on prices to consumers, but there's only so much the consumer can take. There might be a demand pushback. But what do you see going forward?
So inflation is not a good news for the equities market, especially for the consumer goods sector. I mentioned earlier when I was explaining that if you see some of the results, the full year results, you would see that there's a rise in operating costs, the finance cost is high, especially now that the CBN is going to take a much more tight approach in terms of monetary policy, right? So you'd expect to see that the finance costs go higher. Right, and also there's also an impact on the average investors, because what that would mean is that I have little or less capital to invest into the market because of the high cost of living. So if, for instance, if I have 100 million to trade in the market, I would have lesser because I have to manage my cost of living, and that affects the amount of free cash that I have to trade in the market. So it's not so much of the good news for the consumer goods sector. However, we're expecting to see some form of reforms and intervention from the federal government, to sort of ease down the tension a bit.
Well, hopefully that we'll see that happening. Well, thank you so much, Mercy. We'll leave it there. Thank you for talking to us today. We appreciate your time on this show. That was Mercy Okon, research analyst at Parthian Securities.